I'm calling this a melt up. This final stage of this 42-year secular bull market will probably be over, if not this year, and I think it could be this year, sometime in the first quarter of next year. And I really, people will get upset with me because they tell me I keep pushing my timeline. I'm not pushing it. I'm just being realistic that to say that the market can go up 30 to 50% from here, I have to allow for the fact that it's not going to happen in 3 or 4 months. I think it could because it's going to be a parabolic run. I've been a big bull, as you know, been probably the bull on the street for the last couple of years. I turned right at the bottom in October 2022. Actually, was bullish before that, but said I think we hit a bottom that day and it reversed and never looked back. And I've remained with targets that are way above anybody else on the street for a long time. As you say, coming out of October 22, I was at 6,000. I raised my target to 7,000 on the S&P back in January of this year, and raised my target on the NASDAQ from 20,000 to 23,000. I have since raised my NASDAQ target to 24,000.
Wow.
So, pretty steep run from here, in my opinion. I have a 55,000 target on the Dow, which is up from 48,000. And my biggest call is I have a target of 3,300 on the Russell 2000. So that one people have a hard time with because the Russell's been the laggard. But I think you're going to see a big catch-up rally there. And basically from here, it's 50%. So, and I do believe these numbers, I always tell people I'm not tied to the end of the year. I don't give year-end targets. They're really cycle targets. It's the top of what I think is a 42-year secular bull market that started back in August of 1982. So whether it happens, in November, December, January, I don't really care. It's, I'm not going to worry about whether I call it quite that precisely, but I do think there's a real possibility it could be this year that we get there. If we don't get to the final top this year, we'll be darn close. A big part of it will be this year. So, that's a big run from here, and I think probably not the Russell, but I think for the S&P, my number is conservative. So I think it could even exceed that. So I haven't raised it yet, but I'm toying with the idea that I may have to raise that one. So I think it's going to be, I think tech has had a big correction after their great run. Semis have had a big correction. I think they're in gear, and you're going to see those groups lead the market up. So they're going to be joined by a lot of other groups. So it's no longer going to be the case that people can say it's a narrowly based rally. It's not good quality. I think you're going to find that it's a very broad rally into the top. So cyclicals will play, value will play. I think semis, the SMH is maybe 240 now. I think that can get to 400. So there's plenty of upside there. The Mag 7, I think, will continue to be leaders. But at the same time, I think you're going to see industrials play. You're going to see home builders play. You're going to see the materials play. The copper looks great.
Yeah.
You're also going to see things like financials play. So the area that I don't like is the energy area, the oil, the XLE. XLE, I think, is going to lag a lot. It could actually go down, but if it doesn't go down, it's going to at least not be performing very well.
What's driving that?
Well, as much as I've been the bull on the street for equities, I've been the bear on the street for oil ever since it hit 130. WTI oil here hit 130 during the invasion of Ukraine, and then never looked back, never saw that level again. So around 120, I think I said you could see it back down to 85. And then as it got down under 100, I said you could see it down into the 60s. We got down into the 60s a couple times in the last year, and most recently, maybe in the last month. I think it's going to roll over here and probably go to 60 and maybe through 60. So that's that's really what's driving it. There's a surplus of oil out there. The world economy is not great. It's chugging along at a very low rate, and in some cases in recession already. And I think next year I'm calling for a global bust. So, demand for energy is just going to continue to weaken. And meanwhile, supply is, certainly decent. So I'm a bear on oil for this cycle. I think it's had its run. And I'm a huge bull on oil post bust, in the 26 to 30 period, 2026 to 30. I have oil going as high as $500.
What?
So, yeah, I think oil can get down to 30 in the bust. And then, once you're going to have a huge response to a global bust. I'm jumping ahead of myself, but you're going to see a huge response from all the central banks around the world, because global bust means big financial crisis, maybe worse than 2008-9 for many countries. For our banks here, I don't think it'll be as bad as 2008-9 because they got hit so hard then, and they've cleaned up their act. They have much less leverage. But for Europe, for your banks, for Canada, for Asia, I think there's plenty of room there for the banks to fail. I mean, so you're going to have banks failing across the globe, and the central banks are going to have no answer for that other than money. You will see, I've said this for a while, I think you will see, we saw $5 trillion in QE out of the Fed in response to the pandemic back in 2020.
Yeah.
I think you'll see 20 trillion this time. That's just the Fed. So, and proportionally, every central bank, your bank doesn't know it yet. They're fighting it right now, but they're going to be forced to do the same thing. Just to slow down a little bit on the time, I'm calling this a melt up. This final stage of this 42-year secular bull market will probably be over, if not this year, and I think it could be this year, sometime in the first quarter of next year. And I really, people will get upset with me because they tell me I keep pushing my timeline. I'm not pushing it. I'm just being realistic that to say that the market can go up 30 to 50% from here, I have to allow for the fact that it's not going to happen in 3 or 4 months. I think it could, because it's going to be a parabolic run, but I have to allow for the fact that it might push to 4 or 5 months. So it'll either be in the fourth quarter or the first quarter. Following that will be this global bust. And it's a global bust refers to the economy and the financial system. But it'll be accompanied by a bear market that I think in the US will be something on the order of 80% peak to trough. 80%.
That's
so just using my targets right now, if the S&P tops out at 7,000, I'm saying it could get down to 1,400.
What? I mean, so that's like the Great Depression back in the day. So
that's 29 in 1929 we had a 90% peak to trough drop.
Correct.
This won't be probably quite that big, but it could be 70 or 80%. And why? Because when I say global bust, I'm using a term to differentiate from anything we've had in the post-World War II era. Even 2008-9 was not a bust. It came close, but a global bust is really the system is breaking apart. It's in free fall. We almost got there in October of 2008, but we pulled them back from the cliff. When the commercial paper market froze up, GE was rumored to be going under. We had all the banks pretty much down at zero. The Fed acted, and the Fed and the government acted pretty quickly from that point and prevented us from going over that cliff into a bust.
Yeah. I'm
saying this time they won't act fast enough, partly because of 2008 and everything that's happened since then. I'm focused on the Fed, but I think all the central banks are of the similar mind, and that is we don't want to do QE to infinity anymore. We're done with that. We learned our lesson. We're not going to do that anymore. It's easy to say that until you're faced with a free falling financial system. So they're going to be slow. So right now, if you ask Jay Powell, he'd say, no way, we're not even going to do a trillion. We're never going back there. If you asked every central banker, Lagarde or your central bankers, they'd all say, we're not doing that again. That was a mistake. That's what they think now. But when faced with a system that's blowing up, they only have one tool, and that's money. They can't, you can't ask legislators to move fast enough to save a system that's imploding. So the only thing they can do is push the button and put money out there. So once it's and money happens with a lag, right? They'll put money in to try to stabilize the system, and they'll start, and that's why I think we'll have a bust. Is they'll start trying to be modest with it. They'll say, well, we know we're not going back to 5 trillion. Maybe we can put $1 trillion and stabilize the system, and that'll not do a thing, and we'll continue to see the thing falling apart. They'll put another couple trillion in, that won't do it. All of this will happen over the course of days, weeks, and months, and it will take them probably a good 6, 7, 8, 9 months to get to a right-sized policy. It's one thing to say we're putting money into the system. It's another thing to figure out how much you have to put in. And the only way they'll figure that is when the system finally stabilizes. So for a number of months, their money's they're going to be pouring money in, and nothing's, they're not stopping anything. And while they're trying to figure out what's the right size policy, driven by a mindset that says we shouldn't do this, they're going to be slow to act and act in less than appropriate numbers, less than necessary numbers. And while they're trying to get to that level, reluctantly, you're going to have a free falling system. So that's why it can be a bust. It's we're just leveraged to the hilt. You've got 320 trillion in global debt out there. You've got quadrillions in notional value of derivatives. Derivatives are the leverage on the markets, and obviously debt is the leverage on the system. So you've got double whammy of leverage that's beyond anything we've ever seen in this world, even beyond 2008 and 9 by a lot. So leverage is really what takes you down. When you get into that situation, leverage not only increases the magnitude of a decline, but it speeds up the decline. Everything happens in a much faster fashion. So I think 2025, you can go from what seemingly today looks like, yeah, we're not gangbusters, but the economy is not showing signs of disaster.
Yeah.
You can go from that in a few short months, all of a sudden say, what happened? What I like to say is I am forecasting markets. I'm certainly not giving advice. I can't do that.
Yeah.
But I'm also not, everybody has to kind of look at their own abilities, their own risk preferences and tolerance, and decide for themselves, know how nimble you can be, know your own self in terms of, will you get caught up at the top? Because what I'm telling people is the likelihood for most people, and there's plenty of exceptions, but for most people, they're most bullish at the top and most bearish at the bottom. So October of 2022, everybody was sure we were going down, including the best of the best, including all the big institutions. They were all sure we were going down to 3,000 or 3,200 on the S&P, or maybe lower. Yeah. The Fed thought we should go down there. So that was where we were 2 years ago. If we go to 7,000, if we go to 24,000 on the NASDAQ, I can almost guarantee you that all those institutions that were bearish, 100% will go. When the market's at 7,000, it'll be a double from 3,500 in 2022. So where they're bearish at half that price, they'll be all in. And so will most retail investors. So what I'm telling people is, yeah, you can say, hey, this is too risky for me. It's too fast markets. I can't go in and get out 3 months later. That's fine. Absolutely. I'm telling you, there's a horrible bear market to follow. So yeah, that's fine. But know yourself, because you may get out. You may say, I'm out and I'm going to stay out now. But if you get another 1,500 points on the S&P, you're going to feel like I'm missing something. And at the top, the narrative is going to be very bullish, people, there's a lot of skepticism around the market right now. Even, most of the strategists on the street are telling you there's not much upside left. It's a high value market.
Yeah.
And those same people are going to have a rationale. They're going to have a narrative at 7,000 on the S&P that is going to say there's a long runway ahead, that this market has legs, that it can run for a couple more years because the Fed's easing. Know what the rhetoric's going to be. You have to, the saying over here is when Wayne Gretzky, who was a great hockey player, used to be playing, it was, how are you so great? And he goes, I skate to where the puck is going to be, not where it is. So you have to think ahead,
Yeah.
and know yourself. So my forecast is not an endorsement of any investment approach or advice. It's just saying this is what I expect the markets to do. You take that information as an individual investor and figure out for yourself, maybe with the help of an advisor, of how you want to do that. Some people can go part way and hedge. Other people will go all in and know that they want to get, at the first sign of trouble, get out. But just know it's going to be very hard at the top to be a seller.